Over the past 2.5 years, according to the official numbers, and we all know those official numbers are vastly understated, but the central banks of the world have purchased 1,250 metric tons of gold, which is worth about $80 billion. And when we talk about a government that, by its own estimate, will take another 22 trillion in debt over the coming decade just to keep the lights on, so to speak, to roll over the obligations that we have, and to continue to fund our spending habits. Well, that's an awful lot of money, and I'm sure that those are severe concerns. But think about this. Um, in other words, if the central banks were to purchase, uh, let's say, well, 5% hold right now in U.S. dollars, just converting 5% would be another 300 to 400 billion in purchases. Now, an $80 billion infusion pushed gold up to its all-time high. At the same time, we have a strong dollar, we have positive real yields, and outflows out of the ETFs. What happens if they just convert 5% of their dollar holdings? And it seems that this has been a trend that's been accelerating. Now, granted, that's 300 to 400 billion dollars. That's 5 times what they bought over the last couple of years. But what I'm getting at is that as these central banks continue to de-dollarize, they realize that inflation has been chosen over austerity, the way that all governments have.
Over the past 2.5 years, central banks around the world have bought a staggering 1,250 metric tons of gold, worth $80 billion. But what if they convert just 5% of their US dollar holdings to gold? That would inject up to $400 billion into the gold market. 5 times what they've bought so far, driving gold prices potentially beyond $10,000. Now, with the US already drowning in debt and relying on trillions just to stay afloat, this shift could send shockwaves through the financial system. If central banks continue to de-dollarize at this pace, we could be on the verge of an unprecedented financial collapse.
What I'm trying to say to you is this: you add that kind of money, you're talking gold that could easily be up above $10,000, because 80 billion pushed it up here to 2,600 and change with virtually no U.S. participation. And I think that you are seeing and will see kind of like a hockey stick, right? Where the acceleration in de-dollarization accentuates. And I really do believe that that's as crazy as it sounds to me, a conservative estimate. I can't imagine that all you would see is 5% of the 8 trillion in US dollar holdings that these central banks hold around the globe would be converted to gold. I think that number will be much more. But 5% would be 300 to 400 billion injection into gold. And that's 5 to 6 times what they've already bought in the last 2.5 years, which has been the driving force behind the rise in gold. I don't know. I happen to, it's rocket fuel waiting to happen. I really, truly do. And this is a trend that has done nothing but accelerate. I agree. And that's what you see. Plus, we just lowered interest rates. And according to the World Gold Council, historically, every time we see a Fed cut, gold has rallied as much as 10% in the 6 months after the first Fed cut. So we just saw the first Fed cut. We're seeing increased central bank demand. And we're now beginning to see the ETF start to tick up. I mean, in terms of you try to lay out an argument for a bullish case for gold, I don't know their path. And that is one of inflation. And so when you talk about inflation, sanctioning, all of the things that these central banks are thinking of, not to mention the BRICS and their gold-backed settlement currency, which again has been reconfirmed that this indeed is real and will be discussed in the meeting here in the next 3 weeks in Russia. Yeah, I think we could see much higher prices over the next 6 to 12 months, especially as we are now banking another 50 basis point rate cut. At least that's what the smart money thinks will happen. So, yeah, in every metric, gold is at all-time highs. But maybe the flawed logic is that it should be a whole hell of a lot higher, that it's been suppressed for so long that these numbers that we are all awestruck over are really well short of the mark, just because it hasn't been able to reach its real price due to the massive shorting on both the LBMA and on COMEX. Maybe, just maybe, all of these other assets that have reached such stratospheric highs in gold and silver, kind of painting a picture, allowing most people, including maybe even you and I, to sell short where gold and silver really ought to be and where it is ultimately going. And I think you can look at some of the traders at Goldman Sachs and at UBS who might echo that same sentiment. I'm sure we'll talk about that in a moment. All of these banks are systemically tied together. Why did Credit Suisse have to get bought out by UBS? Because it was systemic. And we have a situation where the banks are over leveraged and undercapitalized. And I don't know if it's a premonition. I don't know if it's wishful thinking. I don't know what it is, but there's just this overwhelming feeling that I have that they're going to sacrifice Bank of America. They're going to let Bank of America fail. Maybe that's why Warren is doing what he's doing by yanking all of his shares, not all of them, but a good portion of them. And this is the bank that has to be bleeding massively from their large short position in both gold and silver. Whether it's Bank of America or another major bank, I think the systemic nature of the banking system, and in particular the large commercial banks, is real. It should not be understated. The world itself is quite systemic right now. So the systemic risk in the bond market, where the bond market in and of itself is just because it underpins so many other industries, like the insurance industry and even like the banking industry. And, we're going the wrong way by lowering rates, at least on the front end of the curve. So what does that do to the back end of the curve? But you end up with a situation where this is a problem for funding our deficits. Ultimately, rates must go higher. So here we are again, lowering rates and perhaps setting up these institutions to load up on treasuries, only ultimately to see rates go the other way, because at some point you have to fairly compensate people for taking on all of this risk that the central banks are illuminating here, the default risk, the systemic risk, the inflation risk, and the de-dollarization risk. So, yeah, I think systemic risk, and we've talked a lot about systemic risk, is something that will. It's the same way of saying counterparty risk. Counterparty risk is accentuated because of the systemic nature of everything. The domino right in front of you may not be the bad one, but it could be the 1, 2, or 3 behind you that you don't even see. Quite frankly, I'm surprised that we haven't seen a domino fall yet. If the government wants to move towards consolidating the banks, which I think they do, I know Lael Brainerd does, to issue a CBDC perhaps soon, then I think you have to ignite that fuse. And what better way to ignite the fuse than to let a major player fail, inciting a bail-in, initiating a bail-in, which then really creates systemic risk as people in this country wake up to what a bail-in is and the ramifications of that, the consequences of that, as people run to yank their money out of all of the other banks, which creates more systemic problems in nature. It's real and might be the one thing that we are underestimating totally as to the real problem with the system.
Now that you understand the potential impact of central banks shifting away from the US dollar and toward gold, there's another crucial piece to this puzzle you're going to need to know. To stay ahead of the next big financial move, make sure to check out the next video on this channel, where we dive deeper into how global economic shifts could affect your investments and what you need to do to prepare. Don't miss it. It could be the key to protecting your wealth.